Hey everyone, welcome back to Wealth Daily. The market is still digesting the Fed's expected rate cut, but guess what? New uncertainties are quietly creeping in. This time, the Fed not only delivered the rate cut everyone expected, but also hinted at a more dovish stance. You'd think markets would celebrate, right? Not quite. Instead, we're seeing signs of hesitation at these high levels. And the reason isn't complicated. It's not monetary policy that's slowing things down. It's the real-world challenges hitting the AI sector. Oracle and Broadcom recently dropped some negative news, forcing the market to rethink its overly optimistic view of AI. For months, AI seemed like a limitless growth engine. Now, investors are re-examining capital spending, commercialization, and profit potential. The result: tech stocks are under pressure, US indices are pulling back from record highs, and risk appetite is cooling off. But the real test, it's coming next week. A true heartbeat test for the markets. And this isn't just one event. It's a cluster of big macro variables hitting all at once. We're entering what traders are calling Super Central Bank Week. The Bank of England, the ECB, and the Bank of Japan are all stepping into the spotlight, and their stances. Think of it like a three-way crossroads. One leaning toward rate cuts, one holding steady, and one finally considering a hike after years of waiting. These paths might look separate, but they all lead back to the US stock market. Exchange rates, capital flows, risk appetite, they all come full circle. A single comment from a central bank could set off a chain reaction in global markets. Let's start with the Bank of England. The bull is itching to cut rates, but hasn't fully committed. In the last meeting, the vote was a tight 5-4 to hold rates. While the outcome was inaction, the split tells a story. Even Governor Bailey, who voted to hold, admitted that overall inflation risks are falling, clearly laying the groundwork for future easing. The problem isn't willingness, it's timing. Economically, the UK is under pressure. Unemployment is steady at around 5%, but growth is weak. Core inflation is down to 3.5%, which is improving, but still above the 2% target. The boy is walking a tightrope. Too high a rate and growth suffers. Too early a cut and inflation could spike. Markets have already made a call. Expectations for a rate cut at the next BOE meeting are close to 90%, and midterm inflation forecasts reinforce the case. If the BOE cuts and signals dovish guidance, the pound could weaken, driving capital into dollar assets, which is bullish for US equities. But if they hold or lean hawkish, the pound strengthens. Capital could flow back to the UK, and US stocks might feel the pressure. Now, the ECB, unlike the hesitant bull, the ECB is playing it slow and steady. Their game plan, stability. President Lagarde has highlighted Eurozone resilience, despite global uncertainty, hinting at potential upward growth revisions. Officials are cooling expectations, making it clear short-term rate hikes aren't on the table. Investors expect the ECB to hold rates, keeping markets calm. For US equities, the ECB's inaction is actually reassuring. It provides a stability anchor. A slightly stronger euro may divert some capital from the dollar. But unless the ECB goes hawkish, it's mostly a sentiment play. And now the Bank of Japan. Here's where the drama really heats up. The BOJ has been the last bastion of ultra-loose policy. But now, a rate hike is practically priced in. Multiple banks treat a hike as the baseline scenario and are already mapping out what comes next. If the BOJ hikes, the symbolic effect is bigger than the actual rate change. The yen could strengthen, potentially repatriating Japanese capital from overseas, which could pressure US equities. Even a single BOJ hike won't end the cycle. There's still room to tighten further, forcing global markets to rethink liquidity conditions, especially for growth assets sensitive to low rates. But extreme outcomes are unlikely. Policy interventions can smooth any rapid yen moves. And if the BOJ surprises with a dovish stance instead, the yen might weaken, arbitrage funds flow back in, and US stocks could get a bounce. So next week's Super Central Bank Week, packed with variables. Layer on top of that, a wave of major US economic releases, delayed by the government shutdown. These data points are now hitting all at once. Think of it as a pressure cooker for the market. The first big one, November's non-farm payrolls, the first full employment data post shutdown. Expectations are around 180,000 new jobs, signaling a cooling labor market. Some analysts even suspect actual numbers could be lower, which would shock markets if true. The market reaction won't be simple. Numbers near expectations, signaling mild slowing, might support tech-heavy indices like Nasdaq due to continued Fed easing expectations. But a big miss. Suddenly, recession fears spike, and risk assets take a hit. Then comes inflation. CPI is always a Fed focal point. November is expected at 2.8%, YoY, core at 3.2%. Still above the 2% target, but trending down. Fed officials are debating. Some worry early easing could reignite inflation. Others prioritize growth and employment. How the market interprets this will directly influence U.S. equities, sector rotation, and risk appetite. Add to that Fed communications, potential leadership changes, and liquidity management, they all play into market dynamics. The Fed isn't just moving rates, they're managing expectations and ensuring banking system stability, creating a subtle buffer for risk assets. Finally, earnings season adds another layer. Tech giants and traditional industry leaders report next week. Positive results could stabilize prices, disappointments could quickly deflate optimism. Put it all together. Next week is a perfect storm of global central bank divergence. US economic data, Fed dynamics, and corporate earnings. Volatility will spike, but direction isn't lost. The buoy provides tailwinds, the ECB anchors, the BOJ tests pressures, and the Fed remains the ultimate gatekeeper. What stocks can't escape this recalibration, but their size, depth, and liquidity give them resilience. Markets are never straight lines. They find balance through volatility. Expect rhythm and fluctuations. But the core position of U.S. equities in global asset allocation remains intact. That's all for today. A new trading week is about to kick off. Lots of moving parts, lots of emotions. I hope this breakdown helps you navigate the market with a clearer view. Remember, investing carries risks. Stay rational and cautious. Thanks for tuning in, and I'll see you next time.